I'll introduce Shyam Mehta. He's a senior analyst on our team at GTM Research. He is our lead upstream analyst, so everything from polysilicon to modules is Shyam's game, and he has a lot to say on the future of US manufacturing. Shyam.
Thank you, Shail. So good morning, everyone. Thank you for showing up bright and early. My name is Shyam Mehta. I'm a senior analyst at GTM Research, and as Shail said, I focus on the PV manufacturing landscape, starting with polysilicon and ending with modules. I guess the title of the discussion today, this morning, as I warm you up for the sessions that are to follow, is what does the future hold for PV manufacturing? And the honest answer to this question is I'm not really sure. I mean, you know, given the, I mean, and that would hold for all manufacturing, not just US manufacturing. It's pretty well-known fact that we're in a very difficult time for manufacturers right now. The future looks very uncertain. You know, a lot of the tools and analytics that we've used to apply, that we've applied in the past to try to understand the market and forecast the behavior of the market, you know, have had their limitations proven this year. I don't think anyone was expecting things to be quite this difficult. And I think the entire industry is sort of at a pause, at a loss to try to figure out what's going on. And you know, I think that holds for the market research market as well. I mean, you know, just to give you, you know, my gut feeling, I feel that, you know, this is a sort of return of the dynamics we saw in late 2008, and we expected to kind of persist in the market for a long time, a pretty, you know, long, drawn-out industry downturn with significant amount of consolidation underway, and consolidation is a nice word that hides a lot of ugly things happening at the back. I think that we're in for a time of, you know, structural and fundamental change in the industry with respect to, you know, business models and the competitive landscape, but at this point it's kind of difficult to say. So, you know, I'm going to talk actually a lot about the past and the present and the recent past. And hopefully, you know, by the end of the presentation, you would have had at least, you know, a framework to try to understand, you know, what has happened, and that may be some guide in terms of what is to happen. But, you know, I think it's tough to forecast beyond, I would say, the near to medium term for the manufacturing landscape. So I'm just going to be open and honest about that. I mean, everybody has thoughts and ideas, and I'm willing to, you know, share them with you and receive yours as well. But I think, you know, it's a tough time to be an analyst in the market as well. So with that said, you know, there are a lot of topics we can talk about, even though when you think to yourself, when you restrict yourself to a topic like US PV manufacturing, you think it's a relatively restricted topic, but, you know, given the events of the recent past, there are a lot of different angles that can be discussed, and I think I'm going to, you know, go over a lot of different topics quickly, and, you know, by doing that, and by saying everything, you're at the risk of sometimes saying nothing. So I hope that doesn't happen. So with that, with all those caveats, let's get started with a look at, you know, look way back. So, you know, when people talk about the US as a PV manufacturing hub today, it's reasonably well known that, you know, I would say perhaps polysilicon aside, and to some extent inverters, the US has played a pretty marginal role as far as manufacturing is concerned, you know, in the last at least year or so. But, you know, look at this chart tells us that it wasn't always this way. If you go back to the early 2000s, you can see that the US had a market share of almost 30% for cell manufacturing, which is, you know, if you've just entered the industry in the last 2-3 years, this may be very surprising. You know, and you can see over time that, you know, especially starting in the early 2000s and then sort of leveling off in the last 3 or 4 years, that market share has decreased quite dramatically from about, you know, 27%, like I said, in 2001 to, you know, high single digits today. You know, and when you think about who was doing what the world was like back then, it was a very, very different world, obviously. I mean, if you think about 2001, Germany had just launched the sort of first phase of its feed-in tariff program. Japan was the sort of leading PV market in the world then accompanied by Germany and the US. Those are the top 3 markets, and the philosophy of that time was you build them where you sell them. And that didn't just hold for modules, it held for cells as well. So you had manufacturers like BP Solar with its facility in Maryland. You had what is now, what was until recently the Solar World factory in Camarillo, but that changed hands a few times. You had GE manufacturing cells and modules out of Delaware. So you had these, and these are actually vertically integrated fabs, wafers and module fabs, mid-size fabs. They were pretty large, by the standards of yesterday. And so, the mid-2000s obviously saw a significant ramp up in demand in Europe, and the entry of the Chinese manufacturers into the landscape. And you can see that, while the rest of the, from about 2005 to 2010, if you just look at the absolute numbers, it looks quite impressive. You can see this exponential curve. But the fact of the matter is that the global production was growing actually much faster than that, which explains obviously the dramatic drop-off in market share. So, I just threw that in because it tells you that things weren't always the way they weren't the way they are now, and it's only a few years actually that all these changes have taken place. So, more of the story would be that the past doesn't really serve as a good indicator of the future in PV, which is one of the difficulties you have in terms of trying to understand what's going to come ahead. I mean, it's a completely unique industry, and parallels to other industries like semi and telecom don't really hold up at the end of the day. So, having looked at how things were way back when, let's look at how things are today. And when I say today, I really mean 2010. Right, so it was a year ago when things could actually be even, one would expect them to be, materially different for 2011 as well. But, these are the numbers we have, and it's, there are 2 series of charts here. One is, the US's production share for poly wafers, crystalline silicon cells, crystalline silicon modules, thin film modules, and all modules. So the blue bar is the global production share, and then the red bar is what we estimated as the US's production share for US installed modules. And the idea is to try to understand if there are differing trends there to see, and to see if build them where you sell them actually has any merit. And you can see that, as I said at the very beginning, aside from polysilicon and to some extent thin films, the US has a pretty marginal share in manufacturing, right? And obviously, polysilicon and thin film modules are not to be trivialized at all. Polysilicon especially, you have some very large plants here. You have Hemlock's plant in Michigan, you have REC's plant, or 2 plants in Moses Lake, and then you have MEMC's plant in Pasadena. So they're all pretty large plants. But this number used to be much larger as well. It was 40% in 2009. So even there, the US is in competition. What's interesting to look at is the differing trends. You can see that the production share of the US for US installed modules in terms of the end demand is a little higher for wafers and cells, but not really that much. It rises from 3% to 11%. And but what's most interesting is the trend for modules. Across the board. So you can see that, despite all the talk about the uncompetitiveness of US manufacturing, it does look like there is some kind of a case here when you look at the fact that the US had only 5%, I believe, production share for crystalline modules all over the world, but that number rises to almost 1/3 for 2010. And this might be surprising for some people because 2010 saw a huge build out in production capacity and manufacturing ramp from Chinese manufacturers, and it also saw them make significant gains. But at the end of the day, these numbers still hold. You have a number of domestic manufacturers who enjoyed pretty significant market share in the US. There is a lot of brand stickiness, customer stickiness. There is merit in some degree of merit in locating module assembly close to the end demand location. And then thin film modules is perhaps even more interesting, and that bears witness to the fact that aside from well, even aside from First Solar, there's quite a significant manufacturing presence for thin film manufacturers in the US. So 13%, thin film had about, I think if I'm reading it right, about 13% market share globally, or not. But then that number rises to 67%, 87%. Sorry, I haven't brought my glasses today. In the U.S. So there are some, and that bears witness to the fact that it's not just First Solar's facility you see here. It's a number of smaller, mid-sized VC-funded SIGs manufacturers primarily who have set up shop in California, among other states, and are actually building out more capacity as we speak. And we'll turn to that in a minute. So the next question really is why things are the way they are today, right? And this is a chart that tries to understand that, tries to explain that, to try to understand where what is explaining this trend. And at the first order, well, actually, I'm going to skip ahead to a slide here. So this is our attempt to kind of put together a comprehensive list of the sort of metrics that matter in terms of competitive positioning for a PV manufacturer. And I think this is a good point to start from. So at the top you have sort of the obvious suspect, which is manufacturing costs. We try to keep things as simple as we can here, but the fact of the matter is when you're really comparing apples to apples across technology, the efficiency does matter as well. So that's why we say it's efficiency adjusted. So for example, you might have a thin film manufacturer with an all-in cost of $1 a watt today, which would be competitive with the crystalline silicon manufacturer, but that that's not good enough, right, crudely put, because there's a pretty meaningful efficiency gap between thin film and crystalline, which leads to a BOS cost gap, all else equal, that thin film needs to offset in terms of cost and prices. So there's manufacturing costs, but then people don't always talk about the other drivers, and that's when things get somewhat interesting. So at the very bottom you have a factor that we discussed. We spent a lot of time discussing yesterday, which is bankability or balance sheet strength. And you can see that there's one sort of canonical example of a company that does each one of these things pretty well. So Sharp would be an example of a company that is considered eminently bankable, obviously because it has a very strong corporate parent. On the other, and so this, I would say at the first order, those are the two things that matter the most. But then you also have a number of other factors where if you kind of miss out on either of those, well, bankability is pretty crucial. But if you miss out on costs, in theory, it's still possible to make up for that depending on how you fill the other boxes. So we have product differentiation at the top right, and a company that does that well is, or that is pretty differentiated along this line is, I'm not sure if it's a company that many of you have heard of it. They're called Oders, and they're a flexible SIGs manufacturer that makes fully customizable modules in all shapes and sizes and colors, which I think is a very interesting idea. I don't know if they will be successful or if they will be the company that successfully commercializes this business model or this product model. But I do think it's an interesting idea to kind of skirt around the commoditized market. You also have, what has historically proven to be an advantage, at least for a span of time, which is a historical presence in an emerging market. And I think SolarWorld is a good example of this, at least until very recently. If you looked at SolarWorld's results for this year, at least the first half of this year, it's surprising that despite the well-documented difficulties of European manufacturers, SolarWorld actually did pretty well because it has a very, very strong presence in the US. It's had that for a number of years. It wasn't built up overnight. And that again speaks to the chart that I showed you a couple of slides ago, showing that there is some stickiness, there is some connection between location of manufacturing close to end demand. At least for a given span of time, it has its merits. Then finally, there's a couple of other metrics I think that do matter. One is what Solyndra was trying to pull off, which is technology differentiation that's not aimed at lowering manufacturing costs, because that's kind of encapsulated in this manufacturing cost bubble, but it's technology differentiation that's aimed at the denominator of the LCO equation, which is kilowatt hours. So Solyndra's, one of Solyndra's claimed value propositions was much higher kilowatt hour per kilowatt energy yield. which again I think is an interesting idea, and I think that is where some varieties of thin film win out in certain markets like amorphous silicon or thin film silicon in India and Southeast Asia because of its superior temperature coefficient and its spectral response. It does well in humid and dusty environments. And then finally you have business model differentiation, which is SunPower is a good example of that, as would be for solar. SunPower is a effectively fully vertically integrated company. It has a lot of upstream arrangements through strategic partners, but it's downstream it's fully integrated into power sales and plant and all the way to from system construction and system sales to EPC work to power plant construction to electricity sales. And it's well known that SunPower has one of the highest cost structures in the industry, but it's again with a qualified until now, because everybody is doing pretty badly right now. But until now it had done quite well in spite of having this high cost structure because of its in part because of its differentiation along the business model. So that said, understanding that costs are a key part of this equation, let's turn back to the slide that I was showing you, which is pretty limited importance because it only looks at crystalline silicon module manufacturing. So we're not talking about poly here, we're not talking about thin film here. There's a lot of detail you miss out on. But this is just an attempt to try to come at an understanding of what it is that makes the US a higher cost location versus China. So there's 3 examples here, and I'm not going to name names of who these are, but 2 of these represent, well, one of these represents a recently closed module assembly facility. One of these represents a vertically integrated crystalline silicon facility that may still be up, maybe north of here. And the other would be, a canonical example of a large vertically integrated Chinese wafer cell module manufacturer. So these are all different kind of technology region archetypes. And there's a couple of things worth pointing out. So first of all, the assumption should be made clear. So this is an attempt to talk about what's happening now. So we're talking about, we're assuming a $35 kilo polysilicon price, silicon utilization of almost 6 grams per watt. And then we're assuming that 80 megawatt module fab was buying cells from China at existing market prices. So not spot prices because cell spot prices are close to about 50 cents today. So we've assumed a 70 odd cent cell price. And so the first interesting thing is vertical integration doesn't solve everything for you even if you're in the US. People talk about it a lot, but what's interesting to see now is that cell prices are actually so low that there's an increasing incentive today to, or there's a decreasing incentive to actually vertically integrate if you're in a high cost location. It's easier, you save more money by actually buying your cells instead of manufacturing the wafers and the cells in-house if you're in a high cost location, like the US. So that's why you see the cost structure of that 80 megawatt fab is actually more competitive, than that large or medium size in today's world integrated fab in the US. So that's one point to make, that it's not always as simple as you think. And the second point to make is, where is the real difference? So yes, there is a difference in labor costs and utility overhead costs, yes. But you can see the labor cost isn't really a big part of the equation. So when people talk about labor costs in PV manufacturing, it's a bit of a red herring. And it's more of a red herring actually because the labor costs for a Chinese module manufacturer are often on par with or higher than a module manufacturer in the US because they do a lot of that work by hand. So when people talk about China's advantage in labor costs, it's like I said, it's a bit of a red herring. The real difference, I think, is in the raw material costs outside of polysilicon, as you can see. That's where the difference really comes into play. The supply chain in the US in terms of PV glass, gases, chemicals, encapsulants, backsheets, frames, it's far less developed here than in China. And obviously the supply chain for manufacturing and manufacturing have developed in tandem. So those two things go together. I mean, they have an installed base of probably over 40 gigawatts of cell and module capacity today compared to maybe a gigawatt and a half in the US. So that obviously goes hand in hand, but at least it tells you what's going on. I was talking to someone from Evergreen Solar a few months ago, and they said that it cost them less to buy a finished frame from China and import that until the import duty was came into being. I think which was in May for aluminum frames. It cost them less to import a finished frame than to buy raw aluminum from the U.S. So when you have a disparity like that, that makes a pretty big difference. And we're not really, and this doesn't include, for example, interest expense, which is another thing that people talk about a lot when they talk about, the billions of dollars that manufacturers have received in low-cost loans. And there's a couple of things to say there. One is that, I think at this point it's clear that, those billions of dollars haven't been actually handed out. Those are lines of credit. And the second thing is in terms of actually driving your costs down. I mean, you might have a lower interest cost if you have actually cheaper cost of capital. But where it comes into play is that it aids in your expansion in terms of your scale and vertical integration, and also means in theory you should be able to sell at a lower gross margin to get the same return on investment because your cost of capital is lower. That's where it really comes into play, but not here. So that said, with that comparison, this chart here kind of looks at a few of those metrics that we talked about, and sort of assesses the U.S. In that regard for different steps of the value chain. So the first table you see here is, so it's a matrix. On one side you have the metrics, the other side you have the value chain component. And I really apologize for not talking about inverters, but I don't really know much about inverters, so I don't want to get into that situation. I think we have our own little inverter genius here somewhere. So I think to the extent we have questions about that, I'm happy to take them and pass them on to him. But just focusing on what I know. So for example, so the box that's filled really in the shading represents how important that factor is. So you can see polysilicon, for example, is pretty critical that electricity costs are low. Not so important for module assembly, for example. Again, capital incentives, polysilicon is heavily capital intensive. So it makes a difference for polysilicon. Modules, not so much. Wafer cells and thin film manufacturing, sort of, in the middle. And so having done that sort of analysis, then and this is a pretty rough assessment, as you can see. So this is not exactly rocket science, but I thought it's still interesting to look at, how the U.S. versus Europe and China stack up. So you can see that, China has some pretty, key intrinsic advantages here. Okay, we have capital incentives, access to a low-cost supply chain, low labor costs, low utility costs. But then the U.S. also has, if you look at how the U.S. is shaded, there's only one real gray box there, the supply chain, which we talked about. And relative to Europe, at least, it's not so bad off when you think about, well, actually existing capital incentives that manufacturers have received. Proximity to R&D resource, which is very key for thin film manufacturing. It's at least the pilot lab that you build, or the Fab 1, quote unquote, that where you're actually working or refining the process as you're ramping up production. And that's why First Solar located its first facility in Ohio. And that facility is still around, and it's 250 megawatts. So I mean, what this tells you is that the US is not necessarily inherently a bad location for PV manufacturing. And that sort of brings me to my next slide, which is, so then you take that picture and you try to reconcile it with, well, we had 4 plant closures in the recent past. So we had Cylinder, which I hope you've heard of. And then we also had SpectraWatt, which is a cell manufacturer, a fledgling cell manufacturer based in upstate New York, or was, Evergreen Solar, and Solon's module assembly facility in Tucson. And what's interesting is, let's just focus on Cylinder for a second, right? So people talk, all this, when these 4 plants closed within a few months of each other, the media sort of went crazy, right? The sort of underlying thesis that they thought comes out of this is the US is not a competitive location for manufacturing. But is that really fair to say when you look at Cylinder's failure? I mean, look at the number of things it misses out on, a lot of them, right? I mean, high capex, you're talking about $275 a watt. I mean, how do you expect someone to be compared with capex of $275 a watt when a Crystalline manufacturer has a capex of $1 a watt today? Low efficiency relative to peers. The particular deposition process they chose, which was co-evaporation, very low yield and pretty low throughput as well. So that wasn't going to help them out. So there was not a lot of attention paid actually to try to solve the cost part of the equation on Cylinder's side, which I would say is one of the key reasons for their failure. And they don't do great on other things as well. I mean, the product differentiation, obviously, it was a very unique product. And being a thin film manufacturer, the notion doesn't hold up, it doesn't really make as much, have as much meaning. But they haven't done particularly well on the other metrics, and they would be eminently unbankable if it wasn't for that loan guarantee, right? I mean, the only thing that made them semi-bankable was that loan guarantee, and that turned out to be not such a good working hypothesis in the end, right? Because if you're stuck with a cylinder module now, I mean, who's going to pay you back on your warranty if that thing, doesn't perform as per its specs in a few years? And then the other three manufacturers, so I think the point here to make is you can't necessarily jump to that conclusion. The other three manufacturers, I think, illustrate a different story. And the story they illustrate is when you compare them to Yingli. Even when you think about technology and efficiency, for example, they actually were disadvantaged over Yingli. You look at a Yingli module today, it has higher power rating and therefore higher efficiency than its European peers or American peers. They're commercializing 18.5+% cell technology, or have commercialized today, their Panda cell. So the Chinese have actually even gotten ahead when it comes to technology. So when you put that together and you consider the fact that the other three firms are basically producing the same exact stuff as the Chinese, crystalline silicon modules, pretty commoditized technology at lower efficiency, and no real technology, differentiation. I mean, the message that emerges here is that it's really tough to beat the Chinese at their own game. So if you're playing in the game of crystalline silicon manufacturing, you're up against a lot of intrinsic advantages. So while the US is not inherently a bad place, for manufacturers with no real value to add in terms of the technology, it doesn't make a lot of sense. Now, if you look at First Solar, for example, here, what's interesting is that to actually stay competitive, they've had to check off almost every box, not just cost, right? And if you look, if it would be interesting with SunPower here is you could actually probably check off every single box except cost, which shows you that if you want to compete with Chinese manufacturers and you have a higher cost structure, well, you can succeed, but you need to do everything else right. You need you probably need a differentiated business model. You need a strong presence in a local market. You need to be eminently bankable. You need some kind of technology edge, which SunPower has again. So look at the number of things that SunPower has done to stay competitive to this point. And finally, what I leave you with is, again, something that might upturn your sort of notion of the sort of collapse or demise of US manufacturing. So this is a map of active facilities in 2008, right? And it's color-coded by value chain participation and technology. And you can see that, it's pretty sparse back then. A lot of integrated wafer cell module fabs back then. And here's what it looks like today. So, and you can see that the facilities that have been closed in the last 3 years have been X'd out. So that includes BP Solar's facility in Maryland, Short Solar facility in Massachusetts, Evergreen, Spectrawatt, and the like. So you can see a lot of the fabs that closed are actually these wafer cell module fabs. They just didn't make sense anymore, and they make less and less sense increasingly. But what's come up in their place has been a lot of inverter fabs, assembly fabs, a lot of distributed module fabs, mid-sized fabs. They're 40 to 50 megawatt fabs that are serving local demand in places like Wisconsin, Illinois, Florida, a couple in California, a bunch of them in the Southwest, and thin film fabs, a number of which are still under construction. As well as the fact that the poly plants that are around today are still are still in a pretty strong position, Wacker, Hemlock, and MEMC. When you look at cell and wafer manufacturing, not so much. You have, SolarWorld's integrated facility in Oregon. You have a couple of other wafer manufacturing facilities in Oregon, but they're pretty small, and I think one of them is, one of the two might not be around in a couple of years' time. But the other thing at the high level that this does show is that, this versus this, it's not exactly, the death of US manufacturing, at least on the near term, right? Which is again what I said, it makes sense to talk about. So with that said, I'll just leave you with a few thoughts. Like I said, these, I'm not going to back these up with analytics because it's a little difficult right now. But, here are the sort of thoughts I have on the road ahead. One is that, like I said, difficult to beat the Chinese at their own game, which is vertically integrated, high-scale, commoditized manufacturing. The near-term prospects of domestic manufacturing in the US depend on polysilicon, crystalline silicon module assembly, thin film manufacturing, inverter assembly. For poly, we didn't really talk about it a lot. I'm happy to talk about it in the next few minutes. Fundamentals are pretty strong in terms of the existing plants. I do think the market share is going to continue to drop over time, even with the new Wacker plant in Tennessee, because there's a pretty big build out in China, and there will be one in the Middle East as well. Crystalline silicon module assembly is tied pretty closely to the growth of the end market and the lack of sophisticated distribution channels in emerging states where you have these fabs, because that's what they're serving, places like Wisconsin and Minnesota and other Midwestern states. Thin film manufacturing, there's a very strong case to build your pilot lines and your Fab 1 here, which is, ostensibly would be something like a 100 to 200 megawatt fab in the US, as First Solar has done. But having spoken to a number of thin film manufacturers, especially in the absence of the loan guarantee, their decision would be to build that gigawatt scale fab as First Solar has done offshore. And then finally, inverter assembly, I'm told, is likely to continue ramping with the end market growth, just like module assembly. And that's why we've seen, so many inverter plants sprout up in the last few years. So these are the kind of thoughts I'm going to leave you with. Like I said, it's pretty mixed bag, and there's a lot of uncertainty. But hopefully I've supplied you with some data and a framework for thinking about how things might shape up ahead. So I'm happy to take some questions now. I think we have time for a few, maybe two. Okay, everybody, okay, there.
Yeah, Steve, Steve Hansen from Mortensen Construction. How many of the active U.S. facilities since 2008 and projected for 2012 are from China?
Are from China? Let me think. There is a Suntech fab in Arizona. There is a Wanzhong fab in Illinois, which is a module assembly fab. And I believe for right now, that may be the only two. There is another fab, which actually not on this map, now that I remember it. It's from another Chinese manufacturer, Linuo, which is announced to be built in upstate New York. So that makes three. Yingli announced that they were going to build a fab sometime in 2009. That didn't happen. So a lot of these new fabs are actually, there's a few from the Chinese manufacturers, but it's interesting, there's a lot from the European manufacturers as well as, actually independent small American manufacturers like Helios in Wisconsin and 10K Solar in Minnesota. Okay, well, if there are no further questions, there's one at the side here.
What do you see as the role of taxation in determining localization of manufacturing?
Well, if you look at how things have gone in terms of the placement of fabs in the last few years, I think tax incentives have been pretty important. I think all the thin film fabs, for example, which have been announced. So Steyon's facility in Mississippi, AQT's plant facility in South Carolina, Bounce facility in Indiana. They're all receiving, from my understanding, pretty hefty tax incentives. The same held for Oregon, for Solar World as well. So I think that's pretty key. I mean, it's less important, I think, when you're thinking about building a fab here versus China versus Malaysia, because there are many other high-level factors that come into play, and it's kind of difficult because the incentives that we have here hard to compare to the 10-year income tax holiday in Malaysia. But when you're thinking about if you already made a decision to place a fab in the US, then that's a pretty key metric in deciding between different states, is my understanding. In addition to tax incentives, you also have capital rebates. So Solar World, for example, got a 50% rebate on the equipment cost, a tax credit actually, back in 2008 because of this Betsy credit that Oregon had at the time. It's since been frozen. So incentives matter a lot to local manufacturers. Sure.
Mark Mulligan for Schiller. You had the cost leader efficiency adjusted as Yingli, a crystalline manufacturer, over First Solar. I think their published costs are 70 to 75 cents with 58 as their roadmap. So you believe that a system like right now, thin film cost leader is below in a system cost? Is that why it's not a thin film customer?
Oh, no, that was just sort of, it's interesting, why did I use Yingli instead of First Solar? I guess maybe to keep things simple, but I would say at this point Yingli and First Solar, or Yingli, Jinko and First Solar are pretty much neck and neck if you look at efficiency adjusted cost. I mean, what's interesting is that certain large Chinese wafer manufacturers had been talking about wafer costs of 36 cents a watt for Q1 at SPI. I'm not going to name names here, but you know who you are. And so if you take that wafer cost and you add Suntech's processing cost on that, which is what would be about 45 cents at that time, you get an all-in cost of 71 cents a watt. That is lower than First Solar's cost today. And that is quite alarming if you're for solar. Now those wafer prices, to my mind, don't make a whole lot of sense. But that's the environment we're here in today. Okay, I think we're out of time, so that concludes my presentation. And I think we're going to move right into the next discussion, which